Hello everyone, this is Ash, and I'd like to take a few minutes and talk about some big rule changes that came for your taxes. I want to talk about some highlights and some things that I think are going to be important to know for the people that I serve when it comes to retirement planning and income planning and strategizing on Roth conversions. And I think it's going to be a pretty helpful video. There's going to be a lot more information that's going to come out of this in the future as we learn more about these and find out how they're going to be implemented. So I wanted to give you a quick sneak peek on what to expect. Now, let's dive right in. So we're talking about this one big beautiful bill that passed on the 4th of July in 2025. And it has some changes to the tax year of 2025. So when you file your taxes in January, February, when you get your 1099s and your W-2s and so on for January, that's going to be for 2025 taxes. And some of the provisions are going to affect your taxes for this current year, and some aren't going to kick in until next year. So let's start with some basics. We all know that there are tax brackets. There's the 10, 12, 22, 24, 32, so on until 37. The higher your income is, the higher you move in the tax bracket. Okay, that's pretty standard. What's interesting is that they changed the standard deduction. So, if you are single, the 2025 standard deduction back before the 4th of July was $15,000, and they raised it by $750. If you're married filing jointly, they raised it by $1,500, and married filing separately, same, $750. And then head of household, it went from $22,500 to $23,625. But along with that, what they changed for people who are over 65, now there used to be this rule that was from the tax changes back in 2018, where the Tax Cuts and Job Acts, I think it was called. There was a $2,000 bonus for folks who were single, over 65. That will remain. That's not going away. And married filing jointly, you get an additional $1,600 deduction per person, for every person who's over 65. And that's not going away. What's being added is an additional $6,000 bonus because of this big, beautiful bill. And it's $6,000 per person. And so if you're over 65, the total extra deduction you can get as a single person is $8,000, and for married filing jointly, it's $15,200. However, it is not meant to be permanent. It is temporary. It goes from 2025 to 2028. Now, when we use words like temporary and permanent, we have to understand that all of this is subject to change based on who's in Congress and based on who's sitting in what chair in the White House. So please understand that when I'm using those terms of permanent and temporary, I have no idea whether it's going to actually last in the case of permanent or whether it will actually only be temporary. Those are just the phrases that I'm using because that's what the law says right now. Now, there is a phase out of $75,000 for a single person and $150,000 for joint. So your bonus, this $12,000 bonus, as your income goes above the $150,000, it starts to reduce. But unlike the standard deduction, this senior bonus can be claimed even if you itemize. It does not eliminate Social Security taxes. A lot of people were hoping that there would be no tax on Social Security. It doesn't do that. It doesn't eliminate the Social Security tax, but it can help reduce some of the taxes that you have to pay on Social Security. Now, I want to show you sort of an example of what this is going to look like if you are someone who's in the 12% bracket. So you're married filing jointly, you're both over 65, $50,000 of your income is from IRA or pension, and $40,000 is from Social Security. Your taxable Social Security, based on the provisional income equation, is $28,100. Your IRA is all taxable, of course, at $50,000. So your total taxable income is $78,100. You, before July 4, you got the standard deduction of $30,000 plus the additional $3,200 for being over 65. And so your taxable income is $44,900, which means that a portion of that $44,900 is going to be taxed at 10%, and another portion is going to be taxed at 12%, and the result of that is $4,911, just shy of $5,000. However, with the new tax laws, the standard deduction and the exemptions and with the bonus and everything, that's increased by $13,500. Why? Well, because the standard deduction went up by $1,500 and the bonus was $12,000. So an additional $13,500. What happened to your taxes? They went down to $3,291. That's a difference of $1,620. And what I just did is a very geeky and long way of very simply doing this. If we reduce your income by $13,500, and you're in the 12% bracket, it means you're going to pay $1,620 less in taxes. That's $1,620 is 12% of $13,500. And so these are the tax brackets that you know. And as your income is reduced when you're in a particular tax bracket, that's the percentage that you pay less of. And so most of you who have had conversations with me would know that, I'm a big fan of filling the tax bracket, especially if you're in the 12% bracket with Roth conversions, or if you are just over the threshold. I would encourage you to contribute more to your retirement account to go down from the 22% cliff down to the 12% cliff. Now, if you think about it, what if my income was in the 22% bracket? So if I look at the 22% bracket, which is right at that, a little bit into the $150,000 range, because remember that's when the extra $12,000 bonus starts to get reduced. If our income goes into that threshold, here's what's going to happen. It's the same $13,500 reduction in income, and we would have a 22%. Notice here I changed this to 22% reduction, 22% tax bracket, and so that means that 22% of $13,500 is $2,970 less in taxes. And so this is why, with the additional bonus of $12,500, if we don't pay attention to that and we keep doing Roth conversions beyond, especially if you're over 65, if we do Roth conversions beyond the $150,000 range, you could potentially miss out on a $2,970 tax deduction. Now, for some of you, that's going to be something you don't want to lose. And for others of you, because of extenuating circumstances or your overall plan, you might decide that's not worth it to me. I still want to do the Roth conversions, which is why it's going to be very important to sit down and have a proper planning meeting. Once all of these tax software out there update their numbers and reflect the new tax rules, we will be able to assess what would be in your best interest. Now, the other thing that applies to higher net worth individuals is pretty exciting, is the estate tax exclusion has been permanently increased to $15 million for 2026. So if you were to pass away and you're a single individual and your estate is $10 million, then you're excluded. You are not going to have to pay federal estate taxes, which was good because we really didn't know where we were going to end up with the old rules. Some things were supposed to sunset and so on. So having this be set as permanent, again, the word permanent is a tough one. Who knows what that means? The next administration or another Congress might want to change that. But for now, we know that that's there. And if you're a couple, by the way, that increases to $30,000 because that exclusion is per person. It's also going to be supposed to be indexed for inflation, so that number is only going to increase over time. There's also a permanent extension of the increase to the alternative minimum tax exemption. This is the AMT that if your income is above a certain threshold, then you might have to pay an additional tax on top of the normal tax bracket taxes that you have to pay. But this only affects a very, very small portion of the population. I think it's something like 0.2% of the population, so not likely to impact so many people, but there's a little bit more room than there was before. Also, there's an increase for a short period of time, because this is only going to last until 2029. There's an increase to the state and local tax deduction. That's, some people call it SALT deduction for short. And this could apply to your property taxes. It could apply to income taxes or to sales taxes, but you can't use them for all of the above. You have to work with your accountant to see which ones are in your best interest to use. But that's been increased to $40,000. Now, some interesting things for those who are charitably minded. If you give to church or nonprofit or something like that, starting in 2026, you have an additional $1,000 for single filers and $2,000 for joint filers of charitable deductions that will be counted even if you don't itemize. So it used to be that if you didn't itemize, you didn't matter how much you gave away, it didn't reflect on your taxes. But starting next year, if you're a couple and you give $3,000 to your local church for the year, $2,000 of it will be tax deductible. So that's a good thing. If you itemize, however, you have a floor now. So there's a 0.5% floor established on 0.5% of your adjusted gross income does not get deducted for charitable deductions. It has to be anything that you give above that 0.5% of your adjusted gross income that gets deducted for taxes. And finally, we have some interesting things for children. Now, most of you have grandkids, and so I would encourage you to tell your kids about this because they need to know. There are some pretty interesting things. Of course, you know I have 5 kids, and so these things are pretty important for me to pay attention to as well. We have the child tax credit. It's increased to $2,200 for 2025, and it's not going to sunset. It's made permanent. And also, it will adjust for inflation. So every child you have, every minor is going to get, you're going to get an additional $2,200 deduction for taxes. Now, if your income is over, I think it's $200,000 for single and $400,000 for a couple, you start to lose that tax credit. Also, 529 accounts have been expanded to allow for more expenses. So this is something that they have been doing where in the past it used to be, oh, you could only use it for tuition, and then they extended it to you can use it for room and board, you can use it for a computer, for the books, and so on. And now they are extending it for some elementary, secondary, even homeschool expenses that you can use the 529 as a tax-free expense. Again, generally speaking, with 529s, you're better off to let them grow and not just put money in and then spend it the same year. But it is something that you can do if you wanted to use some of the money in the 529 for secondary or elementary education before the children are much older. We have ABLE account enhancements. So this is, ABLE stands for Achieving a Better Life Experience account. And this is for children who became disabled before the age of 26. You can contribute as much as the $19,000 for them every year, and this will allow these children who may not be able to work and earn a high amount of income. They will not be penalized for having money in their name against things like Medicaid or SSI and so on. So you can, as family members, you can save money for their care and for expenses that they need to live, but they're not going to be penalized for having that money. So if you have family members who are disabled, or especially when they were children, this is a very important thing to know. Make sure you share that with friends and family that can benefit from this. And then finally, we have a pretty genius marketing strategy. It's called a Trump account. So any children who are born between December 31st of 2024 and January 1st of 2029 are going to receive a one-time $1,000 contribution from the federal government. This money will stay in the Treasury Department, and it will be invested for your children, grandchildren, maybe even great-grandchildren for some of you. And you will be able to, the children will be able to have access to these funds when they're 18 years old. It will convert to an IRA. Of course, if they spend the money, they will pay a penalty because they're not quite 59 and a half. That's the whole point of an IRA, is to let you keep it until you're 59 and a half. But if they were to want to spend it, they're going to pay a penalty, and they'll have to pay taxes on the gain because the money will grow tax deferred. But they will also be able to spend from it for education and for first-time home buyer program without having to pay the penalty. They'll still have to pay taxes on the gain, but they won't have to pay the penalty. Family members can also contribute $5,000 per year and per child to this account. It's going to be, as I said, with the Treasury Department, and they're going to invest it in US-based index funds for the children. And this is eligible for not just people who are born in these 5 years, but also for people who 4 years, I should say, but also for people who are under 18. So anyone who's under 18, you can be contributing $5,000 a year for that child. There's a lot of talk about whether this is the best thing for children to have. Does it trump 529 plans? I don't think so. Even if you don't use a 529 plan, you can convert that into an IRA account for children and grandkids. But it is a different type of investment bucket, if you will, for children. What will happen to this $1,000 if you let it grow for the next 18 years? Well, it'll probably turn to maybe $4,000 by the time they're 18. Is it going to change their world? No, but it's something. But I have to say, it is a pretty genius marketing ploy to call it a Trump account. Love it or hate it. That's quite an interesting name for it. And then we have some more income tax provisions. We have no taxes on tips or overtime. This has been in the news a lot. If you are working and you have family members, they should probably know about this. If you're receiving tips and if you get some overtime, there's a certain amount that you are not going to have to pay taxes on. Also, home mortgage interest deduction. So you can borrow up to $750,000, and any interest on that, you can deduct it from your taxes. Again, that's not going to sunset until somebody decides to change it again. And then something very interesting, in 2025, so starting this year up through 2028, you can deduct up to $10,000 of interest on a new car loan. However, it must be assembled in the US. The final assembly has to take place in the US. And this is available for someone who itemizes or does not itemize. But there's a phase out, of course, if you're single and your income is above 100,000, or if you're joint filers and your income is over 200,000. So for those of you who are wanting to buy a car, and of course most of you probably will pay cash, but those of you who want to finance, you can get an interest deduction, loan deduction for the first $10,000, or up to $10,000. So there you have it. There's a whole bunch of tax rule changes. This is going to come into play when we talk about Roth conversions. It's also going to impact when you should apply for Social Security. I don't think this means that anybody should collect Social Security any earlier that they were planning on to benefit from some tax cuts. But it's probably important to run the numbers and see how this is going to impact you. As I said, these things are not going to be reflected in all the financial planning software until about maybe the middle of August or so, I would say. So it's going to be a pretty busy fall running all these numbers and seeing what would be in your best interest. I will say that with all of these tax changes, we have to make sure that we're using them for your benefit. Whether you agree with these new rules or not, whether you think they're going to bolster the economy or whether you think they're going to hurt the deficit, the bottom line for both of those is my responsibility is to make sure that you pay as little tax as possible. And I want to remind you of something that this person said. Most people who are pretty big geeks when it comes to taxes know this guy. This is Judge Leland Hand, and he's famous for this quote: "Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes." He said this back in 1934, and there was a famous case that he was the judge on, yeah, his argument is, look, you don't have to pay any more taxes than you have to, and it's perfectly fine to use the rules that are available to your advantage. And that's what I hope to do for you. Thanks, and I appreciate your time and patience going through this.